Hello friends, in today's session we are going to discuss the case Manglore Electric Supply Company Limited versus Commissioner of Income Tax. First, let's briefly understand this case. In this case, Manglore Electric Supply Company Limited versus Commissioner of Income Tax 1978. The plaintiff company was engaged in supply electricity in Mangalore under Section 4 of the Madras Electricity Supply Undertaking Act 1954. The state government acquired the company on October 15, 1956. As compensation for the acquisition, the plaintiff received rupees 18,42,312 rupees, out of which the income tax officer classified rupees 11,95,602 as capital gains and deemed it taxable. The plaintiff argued that this amount was in the nature of goodwill and should be tax exempt. However, the Income Tax Appellate Tribunal and the Calcutta High Court rejected this claim. The Supreme Court upheld the decision, clarifying that the term transfer is not limited to just sale or exchange but also includes acquisition by the government. Hence, the compensation received for the acquired undertaking was considered a capital gain and was subjected to taxation. Now let us study this case in details. Answer: Manglore Electric Supply Company Limited, Plaintiff versus Commissioner of Income Tax, West Bengal, Defendant. Reference 1978, 113 I.T.R. 635 SC. Subject matter of the case: this case was based on Section 4 of the Madras Electricity Supply Undertaking Acquisition Act 1954, which granted the state government the authority to acquire any electricity supply company. On this basis, the plaintiff company was acquired by the Madras Government on October 15, 1956. Fact of the case. The fact of the case are as follows. First, Manglore Electric Supply Company was engaged in supply electricity in Mangalore city under a license granted by the Madras Government. Number 2, under Section 4 of the Madras Electricity Supply Undertakings Acquisition Act 1954, the state government had the right to acquire any electricity supply undertaking. Number 3, the government announced the acquisition of the company effective from December 31st, 1956, but later enforced it from October 15, 1956. Under Section 5 of the Act, the government provided 3 types of compensation for the acquisition. Number 5, the company accepted a compensation amount of rupees 18,42,312 rupees, which was determined based on 20 times the average annual profit of the past 5 years. Number 6, the income tax officer treated rupees 6,46,710 as fixed capital and the remaining rupees 11,95,602 as capital gain, making it taxable. Decision of the Income Tax Appellate Tribunal. The key question before the tribunal were whether the acquisition of the electricity supply undertaking by the Madras government constituted a transfer of property under Section 12B(1) of the Indian Income Tax Act 1922, whether the compensation received at the time of acquisition should be treated as capital gain and be subject to taxation. The tribunal rejected the plaintiff's argument that the compensation amount was for goodwill and therefore should be tax-free. According to the tribunal, number 1, in this case, goodwill was irrelevant and could not be acquired by the government. Number 2, the property was not recorded as goodwill in the financial statements. Number 3, there was no evidence that the government had acquired goodwill. Number 4. The plaintiff failed to provide any proof that goodwill was separately evaluated. Thus, the compensation amount, excluding the portion attributable to goodwill, was deemed taxable as capital gain. Decision of the Calcutta High Court. The Calcutta High Court upheld the decision of the Income Tax Appellate Tribunal and rejected the plaintiff's argument that the compensation was for goodwill and should be exempted from tax. However, the plaintiff were granted permission to appeal to the Supreme Court of India. Decision of the Supreme Court. The Supreme Court upheld the decision of the High Court and established the following legal principles. Number A. The term transfer has a broad meaning which includes not only sale or exchange but also acquisition. Number B. Acquisition of property by the state government also falls under the category of transfer. Point C. The compensation received by the plaintiff after the acquisition constituted capital gain and was subjected to taxation. Number D. Under section 12B1 of the Indian Income Tax Act 1922, the compensation for a property acquired by the government was taxable. Legal principles established are propounded. The legal principles propounded are as follows. First, under section 4 of the Madras Electricity Supply Undertakings Acquisition Act 1954, the state government had the right to acquire any electricity supply undertakings. Second, as per section 5, compensation had to be provided by the state government at the time of acquisition. Third, the plaintiff argued that the property seized by the government did not constitute a transfer of property under section 12B1 of the Indian Income Tax Act 1922. Number 4, the plaintiff further contended that if the government used force to take possession, it would not qualify as a transfer under section 12B1. Fifth, in legal terms, when ownership of a property is transferred from one entity to another, it is considered a transfer. Sixth, the takeover of any property by the government is tantamount to a transfer. The Supreme Court clarified that if the government acquires a property, it falls under the definition of transfer and the compensation received is taxable as capital gain. Please watch full video, share and subscribe to the channel. Thank you.